18 months ago, Western Digital spun off its flash memory business as a separate company, and almost nobody noticed. It opened trading at $52 a share. Today that company, SanDisk, is up nearly 4,000%, making it one of the best-performing stocks in the entire market. The reason? The same NAND flash memory that's inside an SD card is now the thing every AI data center on Earth can't get enough of. This is what SanDisk actually makes, how a spun-off legacy brand turned into a company worth roughly $266 billion in 18 months, and why, even after that run, its forward earnings multiple still looks cheap. On August 5, 2026, SanDisk reported fiscal fourth-quarter revenue of $8.97 billion, up 51% from the prior quarter and 372% from a year earlier. Full-year revenue for fiscal 2026 hit $20.25 billion, up 175%. And the guidance for next quarter goes even higher, $10.3 to $10.8 billion. CEO David Goeckeler said the company closed the year having, quote, established data center as a key growth pillar. A legacy storage brand just posted its best quarter ever and told Wall Street the next one will be bigger. SanDisk is a publicly traded semiconductor company, headquartered in Milpitas, California, trading on the NASDAQ as SNDK. It has a market cap of roughly $266 billion, on trailing revenue of $20.25 billion and fiscal 2026 net income of $11.43 billion. Here's the number that matters most. Its forward price-to-earnings ratio sits at about 8. Even after a stock that's run nearly 4,000% in a year, from a $52 spin-off debut to an all-time high near $2,350. That's still a cheap multiple for a company growing revenue at triple digits. SanDisk makes NAND flash, the chips that hold data permanently, not the working memory that feeds a processor moment to moment. There are 3 product lines. Enterprise solid-state drives for data centers, now 38% of the bits it ships, client SSDs and embedded flash for laptops and phones, the original business, and the memory cards, the actual SD card brand people still recognize on store shelves. And now there's a 4th, high-bandwidth flash, or HBF, a new memory tier SanDisk co-built with SK Hynix specifically for AI inference workloads that need huge capacity without the full cost of high-bandwidth memory. Google and TensorTorrent have already joined the standard. Here's how SanDisk actually got here. 1988 through 95, founded in Silicon Valley as SunDisk by Eli Harari, Sanjay Mehrotra, and Jack Yuan, then renamed SanDisk, the company that helped invent the modern flash memory card. May 2016, acquired by Western Digital for $19 billion and folded into a larger storage giant. For the next 8 years, the SanDisk name goes quiet on Wall Street. February 2025, spun back out as an independent company, debuting on the NASDAQ at $52 a share. 2025, NAND prices start surging as AI data center demand collides with tight supply. April 2026, the first 5 multi-year supply contracts get signed. August 3, 2026, the HBF standard is unveiled with SK Hynix. August 5, record fiscal fourth-quarter revenue of $8.97 billion, with guidance even higher. And by late August, the board approves a $14 billion buyback, and the stock is trading near $1,800, up roughly 3,900% in a year. So what does SanDisk say comes next? Management expects more than half of fiscal 2027's output already pre-sold through its multi-year supply contracts, rising to roughly 2/3 by fiscal 2028. The company's own estimate for the entire NAND market, it approaches $500 billion by calendar 2027, up from roughly $300 billion this year. Capital spending rises in dollar terms as the next NAND generations, BCS 8 and BICS 10, ramp up, but falls to about 6% of revenue. And high-bandwidth flash is meant to move from standard to shipping product, with Google and TensorTorrent already validating the technology. The bet underneath all of it, that those multi-year contracts actually hold if the memory cycle turns the way it always eventually has. So what's SanDisk's actual edge? The Kioxia joint venture. SanDisk shares the enormous cost of building and running advanced flash fabs with its closest technology partner, spreading a bill few companies could carry alone. Locked-in demand. $93.9 billion in minimum customer commitments, with an average contract length past 4 years, visibility that didn't exist 18 months ago. The brand, decades of consumer name recognition almost no other chipmaker has, and a first-mover position on high-bandwidth flash, co-authored with SK Hynix before most of the industry was even talking about it. None of that guarantees SanDisk wins the next cycle. It does mean the company isn't just riding someone else's boom. So how does SanDisk stack up? Against Samsung, still the clear leader with about 29% of the entire NAND market, SanDisk is smaller and far less diversified. Samsung also runs a massive DRAM, foundry, and logic chip business SanDisk doesn't have. Against SK Hynix and Kioxia, the relationship is stranger than a normal rivalry. Kioxia actually shares SanDisk's own fabs as a joint venture partner, even while it shows up separately in the market share numbers. And against YMTC, China's state-backed NAND maker, the picture is genuinely worrying. YMTC has closed the gap from 8% to 13% of the market in about a year, and is now pursuing its own roughly $487 billion public offering to fund even faster expansion. SanDisk's own share, meanwhile, has been stuck near 12 to 13% for 5 straight quarters. CEO David Goeckeler summed up the year this way. Quote, "We closed fiscal 2026 with a leading technology portfolio, established data center as a key growth pillar, and deepened our customer partnerships. Here's the detail that makes it land differently. Goeckeler used to run Western Digital, the company that spun SanDisk out in the first place. The corporate breakup that looked like a shrug in February 2025 just became one of the best trades of the decade. None of this comes without risk. There's the memory cycle itself. NAND has boomed and busted repeatedly for decades, and nothing structurally prevents the current shortage from flipping into oversupply once new capacity, from SanDisk and everyone else, finally comes online. There's China's comeback, YMTC's rapid share gains, plus a rival, CXMT, pursuing an initial public offering sized at roughly $487 billion specifically to fund more capacity. There's capital intensity. The next NAND generations keep spending elevated even as it falls as a share of revenue. And there's the valuation itself. A forward price-to-earnings ratio around 8 only looks cheap if next year's contracted revenue actually shows up on schedule. SanDisk's own NAND share has sat flat near 12 to 13% for 5 quarters running, and a single China competition headline already cut the stock more than 10% in one day this year. So why does any of this matter beyond one spun-off company's stock chart? Because SanDisk's own numbers are evidence that the AI bottleneck isn't only about the newest, fastest memory anymore. Even the older, unglamorous flash storage business just became irreplaceable. The bull case, a record quarter, $93.9 billion already locked in from 8 customers, and a forward multiple that's still cheap given the growth rate. The bear case, the same violently cyclical business that has humbled this industry for decades, now facing a resurgent, state-backed Chinese rival with a fresh war chest. If the memory cycle turns before those contracts fully mature, a $266 billion company can look very different very fast. So which is it? A legacy brand that Western Digital spun off almost as an afterthought, now proving it was worth far more than anyone guessed, or the same boom-bust memory business about to remind everyone, one more time, why it never traded expensive for long? Comment your take below.